Hello, everybody. In this moment, we are talking about short term financing. Short term financing is the use of credit that is repaid in 1 year or less. Credit is often used because it is more convenient than keeping cash on hand for payments or because cash flows can be uneven at different points in time. The key point of the short term financing definition is the time aspect. A short term equals to 12 months or less. And then, why would a business need short term finance? A business might make use of short term finance to take advantage of an opportunity that may pass them by. Otherwise, the cover unexpected costs or to resolve a cash flow issue. These funds can be used for any purpose, including purchasing supplies or inventory, making upgrades to infrastructure, or anything else. It is not uncommon for a business to require short term finance, especially businesses just starting out who need capital for initial infrastructural investment, such as machines to produce their products or to acquire the likes of office, factory, or warehouse space from which to do business. And then, how does short term business financing work? Short term business financing provides flexible and quick solutions for businesses in need of extra cash. This type of financing involves borrowing a small amount of money for a short period, usually less than a year. The loan may be secured or unsecured with varying levels of interest rates depending on the lender's requirements and the borrower's credit worthiness. Short term financing is often approved quickly, and repayment terms can be flexible to suit the needs of both lender and borrower. Overall, short term business financing can be an effective way to manage cash flow, cover unexpected expenses, or take advantage of new opportunities. And then we move to the types of short term financing. The first types, trade credit. This is the floating time that allows the business to pay for the goods or services they have purchased or received. The general floating time allowed to pay is 28 days. This helps the businesses manage their cash flows more efficiently and help deal with their finances. Trade credit is a good way of financing the inventories, which means how many days the vendor will be allowed before its payment is due. The vendor offers the trade credit as an inducement in a continuing business, which is why it costs nothing. And then the second, business line of credit. It is the best way of financing working capital needs. The business can approach the bank for approval of a certain amount based on their credit line and structure judged through a credit score, a business model, and projected inflows. Then the business can withdraw the amount as and the maximum approved amount. Then they can again deposit the amount as and when it gets available. Moreover, the best thing is that interest is charged on the utilized amount on the daily reducing balance method. In this manner, it becomes a very cost-efficient mode of financing. And then the third, working capital loans. Banks or other financial institutions extend loans for a shorter period over studying the business nature, working capital cycle, records, etc. Once the loan is sanctioned and disbursed by the bank or other financial institutions, it can be repaid in small installments or paid in full at the end of loan tenure, depending on the agreed terms of loans between both parties. It is often advised to finance the permanent working capital needs through these loans. And then the fourth, factoring. It is a similar arrangement of finance like involves discounting. It is debitor finance in which businesses sell their accounts receivable to a third party whom we call factor at a lower and lower rate than the net realizable value. It can be of any type with recourse or without recourse, unlike invoice discounting, which can only be with recourse. And then fifth, invoice discounting. It refers to arranging the funds against submitting invoices whose payments will be received shortly. The receivables invoices are discounted with the banks, financial institutions, or any third party. On submission of bills, they will pay the discounted value of bills, and on the due date, they will collect the payment on the business behalf. And then, the key characteristics of short-term financing for treasurers. The first characteristics, flexibility. Short-term financing allows issuers to adjust their borrowing strategies based on current financial needs and market conditions. And then the second, strategic debt management. Issuers can strategically mix short-term and long-term debt to optimize their capital structure. This mix allows for better matching of debt obligations with cash flow patterns and financial strategies. And then the third, lower initial costs. These methods often involve lower upfront costs composed to long-term financing, making them attractive for managing short-term capital requirements. Fourth, improved cash flow management. Short-term financing aligns more closely with immediate cash needs and project timelines. This alignment ensures that funds are available when necessary without drying up resources for extended periods. And then, fifth, variable interest rates. Many short-term financing options have adjustable interest rates, which can be advantageous when anticipating future rate deadlines. And then six, quick access to funds. Short-term financing solutions are designed to provide rapid access to capital, facilitating timely projects completion and cash flow management. I think it is enough for this session. Thanks for watching, and don't forget give this channel with your like, comment, subscribe and share. Thank you.